The tax consequences could have been horrible. That whole family would have lost $300 and some thousand to the IRS in taxes. Now that family gets to retain that money forever.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 45 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 29. Today I am sitting down with Mark Andresky, and he teaches the class for the RPOA on exit strategies, which I've taken in the past. It's a fantastic course, and he's actually in town today to teach it as well. Mark, thanks for being on the show.
Oh, glad to be here, Brian.
Why don't we start with you just kind of explaining what you do and what your businesses are all about?
Sure. Brian, I'm a certified exit planner, certified business intermediary. And so I work with people that have investment portfolios as well as small business owners developing a long-range transition plan for that portfolio or small business, and trying to figure out how can we turn this into a stream of income that can last a lifetime.
Go into that a little bit deeper. I mean, why would someone come to you for an exit plan? What's on their mind when they come to you?
Well, a lot of folks are pretty good at either building or accumulating assets, but they have a hard time doing the long-range planning that's necessary to figure out how to make those assets work best for them. In a complex regulatory and tax environment with lots of different options, lots of different complexities, very few people are equipped to do it, have the knowledge and skills and training to do it on their own.
So what are some of the mistakes they might make?
Well, tax mistakes are one of the biggest ones. And unfortunately, a lot of times folks engage in transactions and then find out at the end of the year when they go see their accountant that what they did was not done tax-wise optimally. And so they end up with a much larger tax bill that could have been avoided with a little strategic planning ahead of time.
So, for example, what are some examples of that?
One example would be folks, especially some of our long-term RPOA members that have had property for a long time, selling the property and discovering that they owe a ton of taxes for depreciation recapture. They don't realize that all those years that they owned that property and depreciated it, that someday when they sold it, the IRS is going to recapture all of those tax breaks in one fell swoop. And it's even more egregious for the folks that sell on a land contract, thinking that they can spread that tax bill out over a period of years, only to find out that depreciation recapture is due in the year of sale, and and that can be tens of thousands of dollars. For some of my clients that have larger commercial buildings, it can be hundreds of thousands of dollars in taxes.
Wow! So you just said two things that I think might be kind of shocking for some of our listeners. So are you saying that, well, first of all, depreciation recapture, I mean, that's a term that I'm familiar with, but a lot of people who invest in real estate, their knowledge is, well, gee, I get to depreciate this. But what they don't understand, and what you're saying, is that when they sell it, all that depreciation they took, they have to pay it back?
That's correct, and that's often a surprise to them. And they some think that they might be able to use long-term capital gains rates, which are usually much more preferential for most people for their lower tax base that they achieve through depreciation. But that's not true, unfortunately.
And long-term capital gain rates would be what, around 20%?
15 to 20%, depending on your tax bracket,
as opposed to being taxed at a higher tax bracket if you've owned it under 12 months.
Correct. Typically people are looking at 25% plus for depreciation recapture.
Explain. So I'm trying to wrap my head around that. 25% plus for depreciation recapture. What does that
It's
mean?
generally your ordinary income tax rate, your marginal tax rate is the way depreciation recapture is recaptured at the time of sale. And for most people, that's somewhere 25% plus is the bracket that they're in. And so that's the tax rate that would apply.
So that tax rate, that 25% plus, is what you're paying on the depreciation that you've taken, or?
Correct. Yes,
okay.
Because all those years, when you deducted your depreciation, you got a nice expense deduction, a non-cash deduction off of your taxes every year. That was at your ordinary income tax rate, right? You got a reduction in your income for the year because you were able to take a depreciation deduction. Well, the IRS says that that's great, but when you sell the property, we want that tax that you got a break on back, and they're applying generally your ordinary income tax rates, which is typically around 25%. 5% for most folks.
Nice ordinary income tax rate.
Exactly.
So
exactly.
does that mean that when you sell, if you've owned the property for 20 years and you've taken depreciation over the entire 20 years, that entire amount of depreciation that you've taken over that 20 years, you pay back when you sell? Or are you paying the tax rate, the ordinary tax rate?
Yes, the ordinary tax rate applied to that. Say you depreciated $100,000 over that period of time. Well, you're going to recapture that $100,000, and they're going to apply your ordinary income tax rate to it, and you're going to pay taxes. So in that example, it'd be about $25,000 in taxes just on the portion of depreciation that you took over that 20-year period.
Okay, so the good news is that if you owned it for 20 years and you took about $100,000 in depreciation over those years, well, $75,000 of that, give or take,
you get to keep.
You get to keep.
Exactly.
But you're paying,
exactly.
but 25% of that, or $25,000, you're actually going to pay back to the government when you sell.
Exactly. Most people think that, when they're depreciating, a lot of folks realize that they're lowering their tax basis, and so some tax will be due, but they assume that all of that difference between their lower tax basis and the sale price is going to be at long-term capital gains rates, and a portion of that is not. The portion that was depreciated is going to be recaptured at a higher rate.
Wow.
And that's the piece that people miss.
So the IRS, they just come at you from every angle, don't they? I mean, they come at you from the depreciation recapture. They're going to get you at the long-term the long-term capital gains rate. And then what did the other thing you said that kind of blew my mind is that, well, if you're selling on a land contract, I always thought, well, one of the great things about buying or selling on a land contract is that you're spreading out the tax consequences over a period of time. But is it the depreciation recapture has to be paid back all at once?
That's correct. The depreciation recapture portion of that transaction is done in the year of sale. So when you file your taxes that year, you must. And a lot of folks say, well, Mark, that I only got a small down payment on this land contract. I don't have the cash to pay it. Well, that's where the tax bite comes in. Now, the long-term capital gains portion of that transaction can be taken out over a period generally of 5 to 7 years, not the entire term of the land contract, which is also another misunderstanding, not only among investors, but even some CPAs that don't have a lot of experience with land contracts. So It is possible to spread some of the tax bite over a longer period of time, but the vast majority of the taxes are often depreciation recapture, and those have to be paid in the year of sale.
Wow. Okay. So if you're selling a property, you really have to have a conversation with your CPA before you do that to make sure you're not going to encounter some huge tax bills at the end of the year.
Well, that's exactly right. And the transaction may still make sense to you. It doesn't mean that just because you have to pay taxes that it's a bad deal, you shouldn't sell the property. There are a lot of other variables that come into play. I want to actually add an example that happened with one of my business clients recently. We were in the process of transferring his business to his son. It's a family transition plan. And over the years, he had bought and improved an industrial plant that is now worth over $1 million. And he's owned it for quite some time. So he's been depreciating that plant for quite a while. And his first instinct was, well, I should just sell this building to my son while I'm alive. I should just, just sell it to him, and that way he'll have it, and I don't have to worry about accounting for it in my estate plan. And so I did the back of the envelope tax calculation for him and realized that of the $1 million that he might be able to get for the building from his son, that over $300,000 of it would be a tax. And so he would lose almost a third of the value of that building in tax. And so what we ended up doing is a lot of financial planning, and we elected in the end for him to keep that building until his death and to bequeath the building in his estate plan to his son. And that will allow the family to escape all taxes, including depreciation recapture, because what happens when you die owning an asset is that your beneficiaries get that asset at a stepped-up basis. So all of that depreciation goes away, any long-term capital gain goes away, the son inherits inherits the building free and clear, and it has a tax basis of $1 million on the day after his dad's death, and if he were to turn around and sell it the next day, he would owe no taxes on it. And on top of it, in this particular situation, the father was able to enjoy rental income, will be able to enjoy rental income as part of his retirement income for the rest of his life as well. So it was a situation that, the knee-jerk reaction to just sell the building to the son, and I guarantee this would not have, the tax consequences would not have been caught until it was too late, until they were sitting down to do their taxes, could have been horrible. That whole family would have lost $300 and some thousand to the IRS in taxes. Now that family gets to retain that money forever. And so it was a perfect solution.
So help me out here, because it sounds like a perfect solution for the son, because he's going to inherit it and not have to pay $1 million up front to buy it from his dad. And then when his father passes away and he inherits it, well, the value steps up, and basically the tax situation is much better for him. But how is that better for the dad, who does not get the $700,000 of the $1 million he would have sold it for?
Oh, sure. Well, and Brian, you probably know this as an investor yourself. His return on from the rental income, his return on his investment in that building was far greater than he would have been able to achieve by taking the $700,000 in net proceeds, turning it over to his financial advisor, and conservatively, and he was a conservative investor, conservatively investing it in securities, stocks, and bonds. There was no way that we could get the yield, which was well in excess of 12%, that he was achieving, retaining this building.
So
and just
he got to enjoy
the
the rental income that it was already producing.
Exactly. So not only did we, get to preserve $1 million and the whole family legacy plan by not paying taxes on it, but we were able to get him a better return on that money than we could have had his financial advisor just taken the after sale proceeds.
Wow. Okay. Well, that's a pretty big difference there. What do you think of the people out there who have properties that they've owned for a long period of time and been paying depreciation on them, when they go to sell, in your experience, how many of them actually think through the proper exit strategies as far as the tax consequences and all that, versus those who don't and just sell and then get frustrated and disappointed when they get the tax bill at the end of the year?
Well, I think, or at least the majority of the investors and business owners I've worked with, unfortunately, aren't having an active dialogue with their CPAs until these transactions are often either completed or well on their way to being, they're beyond the point of turn back in terms of purchase agreements being in place and whatnot, and then the bad news is discovered. And at that point, there's not much we can do to mitigate it often.
So most people are making the mistake that you just talked about. What's your message to them? I mean, what can you say to get through to people who are listening to this podcast if they're thinking of selling a property or a business?
Well, without being self-serving and saying they should hire me to help them with their long-range planning, aside from that, I think it is making sure that you have the right team in place and making sure that you have a collaborative conversation with that team. So who minimally, even for a small investor with minimal property, who should be on that team? Well, at minimum, an accountant and an attorney. And we want to make sure that we have the right accountant and an attorney who understands real estate matters, who deals with them regularly, and an accountant who also understands rental property. Everyone assumes that accountants know everything about everything regarding taxes, and they simply can't and don't. And so we need to make sure that we have the right accountant who understands the tax ramifications of some of these of property transactions. Now,
an accountant, though, is different from a CPA, right? I mean, because in my mind, I always thought, well, an accountant does the bookkeeping and understands if you get the right accountant, they understand how to keep the books for the real estate, but they may not understand the tax strategies. But are you saying there are accountants who understand all that as well? Well,
there are certainly accountants who are more sophisticated in their practices who just, for whatever reason, haven't attained their certified public accountant designation.
Mm-hmm. Okay.
So I don't want to throw all quote unquote accountants under the bus, because some are actually quite savvy that I've worked with, and just because they didn't sit for the CPA exam does not mean that they don't understand property.
Yeah, and on the flip side of that is there are some CPAs who don't understand it either, right?
Absolutely. And, in my business sales side of my practice, when we're taking a company to market, it's so frustrating to work with an accountant who's never been through the sale of a business before. They might have CPA after their name, but if they don't regularly practice in this area, they aren't up on it, and they don't understand all of the issues that they need to.
Yeah, wow. It pays to get the right people on your team.
Exactly, which was my whole point to begin with. So at a minimum, we need those folks, and we need to tell them well in advance, here's what I'm thinking. Is my thinking correct? Are there some other alternatives I should think about? In my example before about doing estate planning versus just selling this building, taking the knee-jerk reaction of selling this building to a son or daughter or an outside party, it took a collaborative conversation with my client's attorney and his CPA and his financial advisor to figure out if that was the best strategy. It was really that collaborative effort that produced the best solution for this particular client.
Yeah, and it really seems like every situation is sort of a puzzle, and there's multiple pieces. So having those experts on your team who can kind of help put the pieces together, because the lawyer may be aware of one aspect that the CPA is not aware of, and then the sale may be contingent upon things that force you into certain directions. It just seems like it's kind of this big Rubik's Cube that you have to turn until you get all the sides to be the right color.
Those are great metaphors, Brian, and I think exactly describe the situation. It's amazing when you can get a bunch of smart people with a lot of knowledge in a room together talking to each other with a client, what can be produced.
Mm-hmm. And so it seems like in the ultimate situation where you're helping people with exit strategies, you're able to get in the room or at least get on a phone conference with the right people to help come to the right solution.
Right. I'm like the quarterback in the situation in that I have training in all of those areas. And what I'm able to do is ask the right questions and frame the issues and get the discussion going in the right direction, as well as suggesting things that I've seen work in other client scenarios, and at least get that conversation started and steer it towards a solution that really works for the client. And I'm sorry to say that a lot of advisors that get pulled into these situations don't know their clients as well as I've gotten to know them over a period of time working with them. And a lot of times I'm able to tell them things about their clients that they just don't know because they don't have the same relationship and just have never asked sometimes.
Mm-hmm. Yeah, and sometimes as a client, you don't know what you're supposed to share with your experts that are on your team.
Well, exactly. And unfortunately, so many CPAs, just because of the nature of their practice, and also the clients are to blame for this, they just look at their CPA as someone who does their taxes once a year and maybe handles a few questions throughout the year, but that's the extent of the relationship. So unfortunately, it's a lost opportunity for both the client and the CPA that's as far as that conversation's ever gone.
Yeah. For beginning real estate investors who are just starting out, maybe they bought a duplex, they're thinking of buying another multifamily, what would you tell them to be thinking about now as far as exit strategy? Because obviously that's the last thing on their mind, exit strategy, because they're just getting started. But if they take that into consideration now, it very well might help them be even more successful in the future.
Absolutely, Brian. And, private equity groups have gotten this right. They never buy a company without knowing before they actually close on it what they're going to do with it in 3 years, 5 years, 10 years, whatever their plan is. And so we as investors, we get really wrapped up in the deal. We find a great deal and it needs some work, so we get very involved. We buy it, and then we get very involved in the rehab. And before you know it, we've lost our way. We're so busy, getting this investment up and running that we lose sight of where do we want to go with it. And what is our strategy? Why are we buying this thing in the first place? Is it to produce long-term income for retirement someday? Is it to hold for a couple years and sell and trade up to a better property? What are we thinking? And that doesn't mean that exit strategy can't change. I mean, there are lots of folks that buy something and end up doing something very different with it than they thought they would down the road, and that's fine. But at least have an idea of what you're trying to achieve. Let me give you an example. A couple of my clients, two in particular, have amassed very large real estate portfolios, and they're very good at buying, fixing up, and then putting those properties out there to rent often, or sometimes to flip and go on and do another flip. But my whole point is they get so involved in doing all these transactions and amassing all these properties that they lose sight of what the end game is, and they keep on buying because they're good at it. And so at some point, I look at it and I say, well, where are we going with all this? We now have 50, 75, 100 houses in our portfolio. Why? And a lot of times those folks are using some leverage. So, part of their portfolio is leverage. And I'm able to show them through some spreadsheeting, maybe we only need 30 properties to get you to your goal. If your goal is $150,000 or $200,000 a year in income and retirement, I think we can get there with less than 100 houses. Do we need the risk of owning 100 houses for the rest of our lives in order to reach our goals? And so it's been a real eye-opener for a couple of my clients over the years that, you're right. I don't have to put so much effort and time into finding financing and refinancing and managing this massive portfolio of properties when 30, 40 properties might be all I need. And so I can maybe comb through my portfolio and choose the 30 I really like the most and I think have the best long-term potential, and just hold on to those and sell the rest or work out an exit strategy for the rest. But those are folks that just got busy doing, buying, and holding in the mechanics of being an investor without knowing where they were going with that portfolio.
Yeah, well, one of the great things about real estate is the excitement of finding the deal and taking down the deal, and putting it all together and making it work. Selling the deal, maybe that's not as sexy, you get to put some money in your pocket, but it doesn't have the same adrenaline rush of actually finding the deal in the first place. So I can see how people might fall into that pattern of, well, when is enough enough? But it's your job to say, well, maybe you're at enough. And you can slow down.
That's exactly right, Brian. I'm the guy that comes in and actually talks about risk, which a lot of our better investors are not terribly risk averse, which is why, in some cases, why they've been successful. But we do talk to them about the price of risk, and there is risk, as we all found about 8 years ago, in having a lot of leverage on your portfolio,
right.
Especially when banks call notes or are unable to or unwilling to extend lines of credit and so forth. And unfortunately, many of our members, lost proportions of their portfolio during that time because of over leverage. And I talk about the price or the risk of leverage on a portfolio.
Well, let's discuss that. What would you say about the risk of leverage?
Well, I tend to be with full disclosure, I'm a pretty risk averse person, being a financial guy. And so what I talk to my clients about is trying to have a strategy to become debt free, to pay off those mortgages, and let's create a snowball within our real estate portfolio. So by the time we're at whatever our exit age is, whether it's retirement of 50 or 55 or 60, whatever it is, that we have a paid off portfolio, that we no longer have that leverage risk out there.
So getting to the point where if you do have a loan of some sort, you're paying it down so that by the time you're ready to retire, you're free and clear.
Exactly. And I have to tell you that strategy has worked for so many of my clients. I mean, it's a takeoff of what Dave Ramsey talks about. Of course, Dave talks about never buying any investment property without paying cash for it. And perhaps he's right there. But, with the realization that some folks need to, and most of our members do take some leverage at some point in their careers, I certainly did. Let's have a strategy for that leverage instead of just keep on re-upping and refinancing and buying more and more. Let's lower that risk and create a snowball effect and pay them off, and maybe even sell some properties that are lesser properties to do so.
Well, how do you balance? I want to push back on that a little bit, because how do you balance that with the fact that interest rates are so low right now that if you can lock them in for 20, 30 years at this low interest rate, why not take advantage of that?
Certainly we want folks to use leverage smartly. So if they are able to refinance, and that's one of the first things I do when I analyze someone's personal balance sheet and business balance sheet is, gosh, do we have the right capital structure here, and are we paying too much for the capital that we've got on the balance sheet? And so for a lot of my clients that haven't been paying attention, that means refinancing, frankly, going out and taking advantage of some of those long-term rates. But people, it doesn't, if you've been investing long enough, it doesn't take a succession of too many bad events where a property that was performing isn't, and all of a sudden we're paying mortgage on a property and we're having to come out of pocket to keep a property going. And so none of us knows what the future holds, or if we have another recession of 2008, 2009 in our futures. None of us knows. And during that time, the unthinkable happened. Property values went down. They didn't only go down, they went down by a lot. it. And if you wanted to sell part of your portfolio, then you were largely unable to do it unless you were willing to take an enormous loss on it. And so I guess my whole point is that those long-term rates, while they're very attractive and we should take advantage of them as long as we need to, do still carry risk. And having a free and clear portfolio of 30 or 40 houses is far more preferential, especially going into retirement years, than having bank leverage out there. None of us ever knows what the future holds.
That's a good point. Do you have when you say 30, 40 houses, is that sort of a general goal to get to financial independence? If you have 30, 40 houses free and clear, you could say, by rule of thumb, maybe that's a good place to be, to have a couple $100,000 a year.
Well, certainly, if that's your goal, and I have many clients. I mean, for most folks, that's more money than they're maintaining their households on now, pre-retirement. So, is it necessary to have 30 or 40 houses? No, not at all. I think just a handful of good profitable houses that are paid off, maybe 8 to 10 for many people, would be enough. It just depends on the property and what your goals are in retirement. Most folks aren't relying totally on their real estate portfolio. Most folks are going to have some Social Security and income from pensions and other investments that they've made in securities. So they aren't going to rely on their portfolio as their sole source of income in retirement. And most folks aren't looking, have other goals than sitting back and living on several $100,000 in retirement, because they haven't been doing it all along.
Mm-hmm. Well, so is retirement planning part of what you do as well, or is that a completely different thing from exit strategy?
Well, as part of the exit strategy process is the retirement piece. Where are we going? And for many folks, that is some form of retirement, although most of our 40, 50, and 60-somethings want a very different retirement than our parents and grandparents necessarily enjoyed, where they sat back or bought a house in Florida or whatnot and didn't do much. This is a very active group, and most of my clients are going on to being even more active in retirement and activities, and sometimes even new businesses than they were whenever they were working, building their companies and their real estate portfolios.
So let's talk about your clients. Are a lot of them real estate investors, or is it a mixture of real estate investors and business owners? I mean, how would you classify them?
It's both, and a lot of times they're one and the same, in that they own a small business and they also own property. Sometimes that property is just an office building that they run their business out of, or a warehouse. But a lot of times, folks that own small businesses also own a lot of investment real estate, and so I work with all of those. And I also do work with a number of our members that are strictly real estate investors, don't have actual companies other than their real estate investment companies.
Mm-hmm. Now, we talked about the beginning investor and what they should be thinking about as far as exit strategy, even though that may not be on their mind right now, but they should at least take it into consideration. What about someone who's a little further down the road? They've got a portfolio. They're at a point where they're like, where they're saying to themselves, what am I going to do with this portfolio now? What's the smart thing? And now maybe exit strategy is something that's coming into the forefront of their mind. How am I going to pass this on to my children? How am I going to retire? What would you say to them?
Yeah, there are a lot of issues regarding estate planning with real estate. And unfortunately, a lot of folks that have own real estate, they own it because they love it. I mean, our members, as you know, Brian, are really, really passionate about real estate. That's why they're members of the RPOA. And they often make the assumption, because they're so sold on real estate, that the rest of their family is as well. So we have to have some real heart-to-heart conversations with folks when they do their estate planning, and we definitely help them through this in conjunction with their attorneys, of setting some goals and some realistic expectations. If your children have shown no interest in your real estate investing in your apartments and whatnot, forcing them to take those properties and deal with them after your death may not be the right strategy. If you do need to or want to own those properties until your death, and you know that your children really are not going to be able to run them like you ran them or have any interest in doing it, talking with them and putting a plan in place, or at least giving them a list of professionals to call, to contact, to help them liquidate that portfolio is just good planning. We can't assume that our kids want real estate. Now, with that said, I have a couple clients whose children have no interest in real estate, but will probably need the income them, in their opinion, in their retirements, setting up portfolios that go into trust and are managed by a property management company so that their children don't have to touch the properties, but would just enjoy an income in perpetuity coming out of a trust and until through their retirements, which is certainly, with the right estate planning, a viable strategy.
So that's a possibility too.
Absolutely. But let me tell you about another mistake that I see being made too, Brian. We have a lot of folks that were maybe one or two of 3 or 4 children in the family are very involved with their parents in buying and doing real estate. And then we have parents, because they're so concerned about equalization of their estates, leaving that portfolio of real estate to all the children equally. And so all of a sudden we have 3 of the 5 children who had no interest owning property in conjunction with 2 siblings that were very involved in the family property portfolio. And usually no good can come of that. We're a big fan of making sure that those, we call them business active or investment active children, that they inherit the properties, and that we have some other strategy to equalize the estate, either leaving more of other assets in the estate to the other children, but having a strategy in place, other than doing the easiest thing, which is let's just take all our assets and divide them equally among our 5 children, including our entire real estate portfolio, which is usually just a recipe for disaster after your death in terms of sibling rivalry and lots of complications.
Yeah, I can see that happening. So is it just a matter of putting a dollar value on each portion, like the real estate is valued this way, the other assets are valued this way, we'll split it up equally so that you can still spread it over 3 children when only 1 or 2 of those children are actually going to take an active participation in the real estate?
Well, in the strategy on how it's done obviously is going to vary by every family and the amount of assets they have. We do a lot of work gathering all of the financial data on the family, so we know to the penny what assets they have and what they're worth. So we're able to draw that pie chart out and figure out what makes sense in terms of what assets go where. But with all that said, we talk with our clients a lot about it should be fair, not necessarily equal. And by fair, what I mean is a lot of times we have a couple of children who are very involved with their parents, taking risk alongside them, contributing labor and sweat equity to these properties. Is it really fair to divide equally the estate dollar value equally among all the children when the other 3 children perhaps had no interest in that real estate, took no risk with it, and contributed no sweat equity? It's okay to have a disproportionate dollar value being left to family members if that's the case. We talk about how it's completely okay to even sometimes, depending on the level of activity of the children, take those that rental portfolio out of the equation and make sure that it just passes to the 2 very business active children, and the remaining assets get distributed equally among the 5, okay, depending on the level of activity. The facts and circumstances drive it, but parents are so concerned about being equal. Everything has to be equal when they have multiple children. Well, not necessarily if your children have taken risk alongside you and have contributed labor to that portfolio. And so we give them permission to do fair, not necessarily equal. And then, of course, the follow-up to that is it's really important during your lifetime, if that's what you want to do, regardless of what you want to do, to share it with your children. You don't have to share dollar values, but you just need to talk with them so that it's not a surprise when there's a reading of your will or your trust, after your death, that everyone finds out for the first time what your intentions were. If there are going to be issues, let's deal with them while you're alive, because you want to leave a legacy of happy siblings that get along with each other.
Wow, that's great points. I'm sure it must be a tough conversation to convince parents that, well, you don't have to be equal. Fair is good enough.
And in fact, fair is preferential. It's not good enough. Mm-hmm. It's really the preferred way of doing it.
So, Mark, I want to ask you about entity selection, because that can have an effect on taxes as well. Is that correct?
Well, it can, absolutely, Brian. And of course, the first mistake that most experienced, even some experienced investors in my experience have made is not to have their properties placed in at least a limited liability company. And so that's more for asset protection than for tax reasons, because it is a flow-through entity. All of the income is flowing down onto the 1040 personal tax returns. So there's no real tax savings necessarily, but there's great asset protection. depreciation. And on that subject, before we move on, I would just add that a lot of our folks get guilty over time of just loading up one LLC with all those properties instead of segregating them for liability purposes into multiple LLCs. And we see a lot of that. We'll walk in and see $1 million in one LLC, maybe 5, 6, 7 houses in an apartment building.
How would you recommend it be spread out then? Because I think that's a question a lot of investors, as they build their portfolio, ask themselves over and over. Should I put this in an existing LLC, or should I start a brand new LLC for this property? I mean, how would you answer that question?
Yeah, I have some general guidelines, Brian, with the caveat that everyone knows how much risk tolerance they're comfortable with. And so I have some investors that are much less risk averse, and so they're willing to put more equity into one LLC and roll the dice. But just know that if anything happens with any of those properties and a tenant or a contractor sues you, that everything that's owned by that particular LLC, of course, is at risk. And so how much risk are you willing to take? And so some general guidelines I tell folks is, and this has been my experience with clients, is that most folks feel comfortable having $250,000 to maybe $500,000 of equity within one LLC. Obviously, if you own $1 million apartment building, it's not going to be possible to divide that over multiple LLCs. But for most of our folks, they own smaller properties. And so that's sort of, when we get to that $250,000 level, it's time to start thinking about segregating possibly some of those properties.
Starting another LLC for a new property. What about tax consequences, though? I know if you have a single member LLC, it's flow through on your personal taxes. Dual member LLC, however, if you have a partner, well, now you have to have your own separate tax return for that.
That's correct.
What other tax considerations are there?
Yeah, but keep in mind for the partnership, of course, there is a separate tax return, the 1065, that needs to be filed for that partnership. But at the end of the day, all of the partners are getting K-1s, and that K-1 income is, of course, reported on their individual tax returns. So it's still a pass-through entity. But we talk to folks that a lot of our folks are doing really well with their portfolios. So they have a lot of taxable income every year flowing onto their 1040, along with all their other W-2 and other income. And all of a sudden, they have this really big tax bill every year. And it's a sign that everything's going well in their world, but of course, no one wants to pay more taxes than they have to. And so what we start to suggest is if the facts and circumstances are good, it may make sense for you to create your own little property management company. And we generally recommend using an S corporation for that, so forming an S corporation that then becomes your property management company, and any other individual business activities that you may have been reporting just on your Schedule C, you may want to also run through that new corporation. So the idea would be there that your LLCs are going to pay a portion of the rental income to you, to the S corporation, as the property manager for managing those properties. Now, what does that allow us to do? Well, that allows us to do a couple things. Number one, it allows us now to form a qualified retirement plan, like a solo 401k, for instance, or simple IRA that is attached to that S corporation, allowing us to take those former real estate profits and put them into a retirement plan. And that, of course, is tax deferred. It's a tax deduction to the S corporation, all of that money that we're putting into those plans. And we don't pay taxes on that money until we retire and start to withdraw the money, and then we pay it at our ordinary income tax rate.
Well, and then you can get into strategies like buying properties through a self-directed 401k.
Absolutely. That absolutely opens up that world to you. It's a way to take some of your profits and tax, and not pay taxes today, and have that money available, as you just said, through a self-directed solo 401k, and be able to make investments with that 401k in real estate or any other approved security.
Now, is that the primary benefit of possibly setting up your own management company, is so that you can then do the tax-deferred savings plans through that company? Or are there other tax benefits to it as well?
That would be the primary tax benefit for most folks, Brian, is just being able to do that. It's a lot of extra complexity, and of course, there's an additional tax return, for the S corporation that will need to be filed every year. But for some folks whose portfolios are really starting to perform, it can really make great sense.
Well, and in a lot of cases, a lot of them are already managing their own properties, but perhaps they don't have an actual management company set up. like the actual structure.
That's exactly right. That's exactly right. And a lot of times what we find is our members that own properties are also very entrepreneurial. And so they're running handyman businesses. They're running arts and crafts businesses out of their homes, out of their pole barns, and they're reporting all that income as sole proprietors on their Schedule C. Now we can start running this income also through the corporation and using the qualified retirement plan to help defer some of that as well.
Yeah. So if you have a portfolio that you're managing, but you haven't set up a management company or some sort of S corporation, would it be an S corporation?
I like S corporations, yes, for this purpose.
But some sort of corporation.
Right. It could also be a limited liability
to make it official in some way, you're leaving a lot of tax savings off the table.
That's
or
correct.
on the table, I guess.
Well, right. Yeah, you're losing a lot of money today that could be invested that will be earning returns for the next decade or 2 or 3 until you retire and start withdrawing from that retirement plan. Now, I would not suggest that any of our members go through all of this complexity unless they are committed to saving a portion of their real estate profits every year. If you are spending every dollar that you make, then this is not a fruitful thing to spend time and money on today. But if you have a lot of money left over at the end of the year that you just pay taxes on sitting in your bank account, then this could be a much more productive way to invest and not have to pay the IRS all that money today.
Yeah, great advice. Any other advice for our listeners as far as exit strategies or tax planning?
Well, I think you just said the key word, Brian, and that is planning, having a plan, and just realizing that plan will change over time. A lot of people don't ever plan because they're like, well, it'll just change. Well, if we don't know where we're going to, we'll never get there. So it's okay if the plan needs to change regularly. In fact, that's a good thing to revisit that plan and see if we need to course correct. But if we don't have some end goals, even if they're just tentative end goals, we're never going to get there. And so I would encourage our folks to develop written plans today, hopefully in conjunction with their well-chosen advisor team.
Well, Mark, that's great information, and I think that's a perfect place to wrap it up. And maybe next time you come back, we'll have a conversation about your portfolio and how you're integrating these strategies into your own exit planning.
Yeah, that's great,
well.
Brian. I would love to do that. Thanks so much.
Yeah, thank you for being here, and it's been a pleasure talking with you.
My pleasure.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.